on a hammer. So you are seeing here there is a hammer here at this point. So this is a hammer, guys. You are seeing here. This is a hammer. You can see it. So now we talked about it. A hammer, it forms at the end of a downtrend. So you'll see it here. But regardless of the trend, if the trend is too strong, the hammer will be invalidated. Okay, so it depends when and where has it been formed. Okay, now sometimes it occurs that maybe you've seen that hammer, and remember this is a 3-minute time frame. Maybe you've seen the hammer, maybe you are expecting for buys. You are saying that buyers are sellers rejected lower prices because this week down is indicating that sellers rejected lower prices. When sellers reject lower prices, it means that buyers now are taking control of the market. But what did it mean? They rejected the lower prices. Now this next candle, again, it had to fill the wick. So it means that this candle had an unfinished business. So this candle had to come down to fill this wick again to continue in another direction. Okay, so if this candle had finished its business, we could see another candle rising up like this. We could see another candle shooting up like this, up like this. So we could see another candle shooting up very fast like this. Okay, but since the candle had unfinished business, yes, they had to fill the wick. So that's the first candle we talked about. We talked about the hammer. So the hammer is an indication that maybe buyers are in control of the market. So those of you who are still new in trading, so this video is more for you. It can help you even if you're a beginner. Now you can understand what you're dealing with. This is the first core of every trader. Okay, you have to understand how these candlesticks will move. Then you have to look for the strategy. Within that strategy, you will find these candles inside there. You will find them. So that's the one thing you've looked at. Now we are going to see that we have also bullish engulfing bars. So bullish engulfing bars, we have evening patterns also. But here we are seeing that here at this point we are having a here we are having a bullish harimi. So this is a bullish harimi. So there is what we call a bullish engulfing bar. Bullish engulfing bar. So how does a bullish engulfing bar form? So a bullish engulfing bar, it will form like this. The first one is a short one. The second one, we shall see that the second candle, we shall see it is larger than the first one. So in most cases, these bullish engulfing bars, for people who are trading smart money concepts, they will help us to identify the demand zones. Okay, and when these candles occur, when this pattern occurs, that zone will be very, very strong. And so guys, you know it. Okay, so it will be very, very strong. Yeah, that is it. So you can see it here. So this is a bullish one, but remember this harimi is not very strong than the bullish engulfing bar. So this is just it shows a small retracement. Buyers will come, but they will not be more powerful than the bullish engulfing. So this is just in mostly occurs in the continuation markets. Okay, but the bullish ones can occur also in the retracement market. So we wrote about this candle here. So those who are writing, you can write it down. So we have talked about now 3 candles. We have talked about the hammer. We have talked about a bullish harimi. So we have talked about a bullish engulfing bar. You can see them. Also, we are going to see the morning star. So someone can ask, how does the morning star look like? So the morning star, also, this morning star pattern, an ICT trader can see that maybe equity was taken out within this middle candle. We are seeing that accumulation, manipulation, and distribution. So the first candle maybe was accumulating prices. The second candle maybe it was manipulating prices. Now the third candle, you will see that now it is in distribution. When the third candle occurred and closed in line with the trend, you see, like as I've been telling you, that these things will work when they are in line with the trend, and they will be invalid if they are not in line with the trend. So, and depends which time frame are you seeing them. Okay, so the higher the time frame, the stronger is going to be your setup, and the lower the time frame is the vice versa. So the lower the time frame you're trading in, the weaker the setup. The higher the time frame, the stronger the setup. Just because if you're trading the higher time frame, then you have to have enough capital to risk. Okay, so at some point you realize that you should have enough capital. So the higher the time frame, you must have enough capital. So if the capital is small, you will not survive, like it or not. So if the capital is little, then you have to trade micro time frames to reduce your risk, because the risk goes on increasing as you climb the time frames at the top. So, and the risk decreases if you are going down the small time frames. That is it. And someone can ask that, how can I reduce my risk? The risk can be reduced depending on which time frame are you getting the setup. So if you are getting your setups in a higher time frame, and you don't increase your risk, it means that you are going to be stopped out, like it or not. So you only have to understand. So trading, as I'm also tell my students this time round, I've been telling them since last week, that trading is a business. It is a skill. So you have to see it as any other business. As an entrepreneur, his work is to set a business and make profits. So the major aim is to set and make profits, but you have to minimize the losses. So we can't avoid the losses in the system. So the losses we make, those are the errors the system was made for. Because without losses, the system will not run. So there will be room for those errors, such that the smart people who are moving the industry, smart people we have JP Morgan, is one of the smart people in the industry. We have BlackRock, we have Gold Shackman. So those are the guys who are moving this market. So if you look at them, they have smart systems, but those systems, of course, they need to be operated. So that's why they will tell you keep on losing money. Okay, so if you can see this candle, so this is a morning star. Morning star, we have looked about it. So we are going to also see an evening star. So evening star is the opposite of the morning star. Where is the evening star here, guys? So I'm going to upload this video on my YouTube channel. Those who are not available this time, I'm going to upload it for them. Evening star. Let us look for the evening star here, guys. So you'll find it. So an evening star, we said in the exams, those who did the exams, you remember them. So an evening star, we say that it occurs at the end of an uptrend. So if the market has been ranging up, the moment it occurs, it is a strong reversal in the market. Whether you're using which strategy, the moment this pattern occurs, you just see it. You can see it. So it is a 3 candle pattern. Those who did so, one of my students scored 70%, another one scored 80%, but they are still new in the market. So it shows that uh, the future has started. So I'm seeing some serious traders who are going to put out now the knowledge uh, in the market now, this time round. Okay. So this is an evening star now. You can see it, guys. Yeah. So as when I was talking about, so candlesticks are the core of every financial market. So you can't do away with candlesticks as long as you want to make money in the financial world. So you have to understand them. So these are the cores. Then we keep on upgrading depending on the strategy now. We keep on refining your strategy. Okay. Now this evening star, when it forms against the trend, it will be invalid. But when it forms with the trend, in most cases it shows reversal. When it forms when the market is changing, it will show a big drop. So the market was trending up, is what I know. If we can look at the left, you see that the market was trending up. But when it showed up, the market dropped out even 2000 pips. Remember, this is gold. 2000 pips. Let us measure. So we use the measuring ruler to measure the distance and the depth. So in every market you will find that there's a depth. What's the market depth? Eh? So as a trader, you have to see these things like a business person. What's the depth now? Where are we going? So the depth, you are saying the market dropped to 1200 pips. So 1200 pips, that is a big drop. But remember, as I've told you, that the higher the time frame, the bigger the risk. So what was your risk? Eh? What was your risk here, guys? So you will see it. You will see it, guys, here. So the zone was too risky, 200 pips. So someone now is going to place here 0 point. Maybe someone is going to, the moment you place a big lot in this zone, when you don't have good capital, the account will go and the setup will play as expected. Why were you stopped out? Because maybe at some point, because we shall see that maybe at some point the zone was too big, and when the zone is too big, you couldn't survive. So the risk setup is most important. So you can see it, price started dropping down rapidly like this. Okay, price dropped. So this is what we talked about last week. Yeah, so guys, keep noting down. So here we are seeing a favor gap. Now we also talked about a bearish engulfing bar. So what is a bearish engulfing bar? So a bearish engulfing bar, bearish engulfing, it means that bearish engulfing means that the second candle is engulfing the bullish candle. Okay, bearish engulfing means that the second candle is engulfing the bullish candle. That is what we know about the bearish engulfing bar, that the second candle is engulfing the what? The bullish candle. So guys, one thing you have to know, you have to share this video to your friend, those who don't understand even anything in the market. Okay, there we go. Okay, so bearish engulfing, I've said the second candle should be larger than the first candle. So engulfing means that it has been covered, the candle has been covered, which was the first one. So you will see it here. If you look at this pattern like this pattern, you can see it here. You can see this pattern here like this. So that is an engulfing. And as we go on, Those who have joined and you are in my private mentorship, you will see it. The moment you start demonstrating the smart money concepts, how do because smart money concepts, what is smart money? That's the first thing you must know. Hmm? We looked up about it. What is smart money? You knew the answer. Smart money, here we are studying how institutional traders move the market. So uh, institutional traders trade using smart money. What are the key players? Hmm? Key players, these are the big banks. So you are seeing this candle is representing an institutional trader. You are seeing it. Hmm? Yeah? Every big candle you see here, that's an institutional trader on the chart. So those are the smart people now alive. So these small candles you see here, these are now the retail traders who are trying to catch up with the trend. Okay? For them, they have already made money at the beginning. The retail traders are going to come. Okay? So that's how the market move. Eh? So it is driven by these people. The key players, we saw them in the market, we saw them. So this is a bearish engulfing bar. So how does a bullish engulfing bar look like? I showed you it. So we shall use, so now we shall combine price action inside SMC. You see how how do these things align when we start getting now the setups. So remember yesterday I gave you some assignment. You have to present a bullish choke. How does a bullish choke form? So you should present your videos, you send them in the WhatsApp. Guys, I told you that. How does a bullish choke form? Then you have to explain how is it forming at the start, and where are you going to enter. So yesterday we explained a bearish choke, how it forms. So I told you that's the assignment. So how many patterns have we talked about? Okay, so we saw a doji, a doji, a doji. Its work is it is an indecision candle. An indecision means that buyers and sellers are equal. So the market has nowhere to go. And each candle is more powerful in its time frame. So the higher the time frame, the powerful the candles. The lower the time frame, the weaker the candles. Okay, so you can see. So they are directly proportional. Okay, that the higher, no, they are inversely proportional. The higher the time frame, the stronger. So it is directly proportional. The higher the stronger, the lower the weaker. So the trend is directly proportional. Eh? So they are directly proportional to the setups and to the trend. So if you look for a doji candle, doji candles, so you have seen a doji candle when you are trading supply and demand, and you ignore it. So you are going to just be stopped out. So when you are trading, especially day trading, being a day trader means a lot. You have to understand now a lot of things when you are trading, because you are going to close your trades within the day. Yes. Here we are seeing a doji candles. It has a small wick and a small body. So, but when we see dojis, there are many types of doji candles. Okay, there are many types of doji candles. You can see them here. So the first doji candle is here. This is a doji candle here. You can see it in the middle there. A small wick. For it is an indecision. Indecision. That buyers and sellers are equal to the market. So buyers and sellers are equal to the market. So you can see it. So here I've told you that people are always fighting within one candle. So if you see here who won the battle, no one won the battle. In one candle there is always a battle. The buyer is always there, the seller is always there. Eh? So this is what it means, that when you are trading, the moment you execute your setup here in this buying candle, you have to be thinking of two things. This candle, it may close as a selling candle. So the most important thing, how does the candle close? Not how is it moving. It may move bullish, but when it closes, it is now bearish. Why? Because sellers have overpowered the buyers. That's what I'm talking about. So in every candle there is a battling field. People are always fighting the market. Who is the winner at the end of the day? Because at the end of the day, for you, even if you lose money, people out are making money. The big banks, for them, they are making money. The institutions are making money. At the end of the day, they will make money. Look at the transactions every day in the Forex market. Over 7.5 trillion US dollars, the trading volume and the transactions in the Forex market. Ask yourself, where does that money go? For you keep on losing. It does not mean that the whole world has lost money. No. The volume is like that, 7 trillions to 7.5 volume moving every day in the market. Okay? So, at the end of the day, there will always be a winner at the end of the day. So, with oil trading, for us, we are always 50-50. For a trail trader, you come in the market, you are 50-50% probability. There's nothing like 90% probability that the thing will work out the way it is. No, it is 50-50. You come, you execute, sometimes it will fail. Another time you come, it will work, it will play out. Yes, institutional traders, for them, 99% they can be on the winning side. So the 1% means that at some point they can lose, when maybe there are some other political factors. Okay, yes, maybe also things fail, also they can lose at some point. They lose at some point. So just because for them they are in higher probabilities of winning. So you are seeing these candles the way, so these are the candles you see here. So this is a doji candle. I've told you it. It's an indecision candle. So maybe you have seen it, you're holding your trade, so you have to close some trades. If you've taken 100% of the trades, you close the 50, then you set your BEs, then you hold. Because when these candles occur, the market is communicating to you. The market is, candlesticks are the mother of the market. They are communicating to you what is going to happen next, regardless of your strategy. So even that's why no strategy works 100%. Even 80% is not there. Okay, because why? The candles will violate your strategy very fast. You will come, you test it, you see it works, but when you start in trading real funds, maybe you trade the pump farm, then you understand that maybe this strategy is not working. The strategy works, but the things like this, the winning rate in your strategy, it is what you're not maybe understanding. Now, the winning rate, because if you read some books, they will tell you that even a 40% winning rate strategy can make you rich in trading. 40%, it can make you rich. Yes. So you don't need a good winning rate strategy to make money in trading. You only have to have the winning rate, even if 40%, but you have to manage the risks very well once you take the trade. Once you take the trade, you have to manage the risks very well. So we have looked about it. So that's a doji candle. So we also talked about the spinning top. The spinning tops, they represent like a doji, but they are not dojis. Spinning tops, spinning tops, you can see them. Okay, so each pattern is powerful when it is combined with a trend. So if these spinning tops form at the top of an uptrend, it means that the market at some point is going to reverse. Okay, so you will see that at some point the market will reverse. Okay guys, so that's what we shall see. We talked about the spinning tops, so these are the spinning tops now. Spinning tops. Okay, yes, for them they spin at the top. We talked about the inverted hammer. So you can see these are the hammers. These are the hammer and inverted hammer. So why is it called a hammer? Because a hammer has a handle down and it has a head up. So maybe this name was looked at the, so it was got from that weapon. Okay, so inverted hammer, how is it forming? At some point you can see price forming an inverted hammer within the support zone, then you take a sell. Are you seeing this? This is an inverted, it's an inverted hammer. So it has been formed. So an inverted hammer and a bullish hammer. An inverted hammer is a bearish hammer, that is it. But when it forms within the zone, it is weak. So these candles, they can only be strong when they form within the right zone. Okay, they are only strong if they form within the what? The right zone, guys. So that's the one thing you have to know. The candles are only strong when they form within the right zones. Okay guys, so you can see it here clearly. They are only strong when they form within the right zone. So that is it. So yesterday, that was what we looked at yesterday. So that's the first thing. You have to understand these 9 types of candlesticks. So in summary, you can see that we have summarized now everything down. How many candles are those? You can see here, this is 1, we have 2, we have 3, we have how many? We have we said the 3, 4, 5, okay, 6, 7, 8 up, 9. Okay, here 10. Okay, 9, 10. So we have 9 profitable candlesticks. 9 profitable candlesticks. When they occur, they have a strong meaning. So guys, are you seeing this? So this setup, this is how CPI moves. Okay, yes, CPI moves like this. Now you can see now this, guys, you can see. You can see now. So the next video, we are going to see that we are going to explain. Now you are seeing this. Buyers have rejected higher prices. Buyers have rejected the higher prices. So this is what I was explaining in the 9 profitable candlesticks. So don't forget to like and follow and share this to your friends. Okay, so what are we going to see now? If they are taken out, what are we going to see? If buyers are rejecting higher prices, what are we going to expect now? But remember, there is a wick somewhere here. A wick is somewhere here. So what are you going to expect to see? So the most important thing is how the candle closes, not when you're in the trade. The moment for me, when I enter trade, I will see how the candle is closing. So when the candle is closing, it will give you a message. It's like a signal that bro, here we are moving, keep holding. Maybe you get a signal, here we are retracing. Okay, so you have to be fast in execution, and you have to be fast to cut losses short, because there's also that one rule in trading: you have to cut losses short no matter what. So this candle only is showing that people have already lost the money. Why? People were buying, people started buying from this point now. But how did the candle close? The candle has closed in a bearish way. It has delivered 300 pips. 300 pips, now it is dropping 400 pips. So that's what I was saying, that for a retail trader, you are always 50-50% probability. Okay? Regardless of result. So when you in every candle there's a 50% probability for the candle to move in your direction. Now the 50 in that candle, you have to calculate it with your winning rate. Yeah? Okay? Let's say an example. You have an example. The probability of death is 1. The probability of life is a half. So the probability of dying is always 1. The probability of living is 0.5. Okay? So in the 0.5 you have to make higher chances of looking for the way of surviving. That's how they think. But the probability of 1, if for 1 is fixed, so it is so when the probability is 1, it means it is a must. So when you find a probability representing 1, because the highest probability is 1, so even in trading there's no probability which hits 1. If you take it in percent, that's 100%. So there's no probability in calculation where it shows 100%. Most of the probabilities are in 50% probability. Okay, the same thing here. Okay, yes. So you have to apply those concepts here. That's to understand how these things are moving. Okay, so for institutional trading, for them they have selected higher probabilities, because for them in every country, for them they are fighting, and they at some point they will know who is the winner. Okay, yes, there is always a battle between between a buyer and a seller. So there is always that battle between a buyer and a seller. So that is it, guys. Okay, so we shall always see it.